Hey everybody, it's Michael Martin. Thanks for being here. Happy Monday. It's a good week. It's kind of like I have the extremes going emotionally. I'm in mourning over Michael Marcus, but baseball season started. So I have two extremes happening in my brain. Thanks everybody for, subscribing to the show. I appreciate it. And leaving comments or up arrows, like and subscribe, because I get some good data from that. And I seem to be building some momentum thanks to your feedback, because then I know what it is that you like. Who needs to sit and listen to me even for 5 minutes if it's on something that you don't care about? I'm not going to waste your time even if it's for 5 minutes. So see, I don't want to waste my own time for 5 minutes either. But so a couple questions came in via the comment section, so I can address those, because in my experience as a teacher, usually if one person's asking, there's probably a few other people who have a similar curiosity, if nothing else. You notice I also get rid of that nagging cough. I'm sorry about that, but I'd rather do the episode and hack my way through it like I'm an ex-smoker, rather than not create content. So one of the questions came in about, let's just see here. I'll read it. From Matiha. This came in on this past Friday. Michael, how many trades weekly do you open get filled on average? And the answer is actually very few, less than 10, mostly because I've realized that most trades are suboptimal, even in the setups that you would look for, right? Or whatever trading rules you might have. If I do get filled, between 5 and 10, it could be 10 orders of the same instrument. Now, why is that? It's because, well, it's a longer story. Let me see. Do I want to get into this now? I don't, but I feel like I opened my big mouth, so now I kind of have to. When you trade, you keep data, right? You keep your general ledger. What are all your trades? And so what I came to find out with my own style, right, which is as unique to me as are my fingerprints, is that I have good instincts from a gut feel kind of a trading standpoint. But I noticed with some of my trades, I'd put the optimal position on all at once. That's the old way. I don't do that now. But then I would get knocked out a certain percentage of the time. In fact, half of my losing trades were ones where I got in with my optimal position, but then I got knocked out because my protective stop got hit. And so I said, okay, well, that's half of my losing trades were trades where I got in and I got knocked out, relatively quickly. However, those trades, eventually went on to make money. So I kept thinking like, okay, well, how can I do this? I'm in a trade early, right? That I got knocked out of, the old Mike, and then the damn thing would go work. So I said, I got to work on that. How can I make an adjustment to my behavior? Because my behavior is going to predict where I end up at life. I don't mind drawdowns as part of life. If you're going to be a professional trader, you learn to live with losses and the frequency with which you lose. Otherwise, you're going to have a tough time. So then what I did is I adjusted, right? Because my instincts were right, but my timing was bad. Remember, we can lose money, bad analysis, bad timing, just dumb bad luck. You're going to get all three. So conjugate that with your emotional constitution now. You might not like it, but you know that that's going to happen. So my take is like, if you get pissed off about that, that's your problem. That's acting like a teenager as far as I'm concerned. I would never have any of my traders tolerate. I don't deal with complainers, because complaining means you're weak, and it means you're not in the solution. So we try to think optimistically. So I said, okay, well, what if I took those trades that I, with my optimal position, got knocked out on? What would happen if I held on to them a little longer? So you go through the back test, and what happens? Well, of course, you get bigger drawdown. So instead of stopping and knowing, that you have all these trades you get knocked out on, your drawdown's bigger, even though you might go make bigger money. So now you're looking at that ratio of what's your best year compared to what your biggest drawdown is. For a lot of people, that ratio is 1-to-1. And if you look at most even anything that's trying to emulate like the S&P 500, those types of managers where the S&P 500 is their benchmark, I guarantee you very, very close to a 1-to-1 ratio. And these are people of gigantic marketing. People might have professional designations. They might have a MBA. And they're, super, connected as human beings, so they can get really good information that, might be in that gray area of what's public and what's private. So then I said, okay, well, what would happen if I took that same name, but I cut my position size in half? I think that's what I did. And I back tested that. But then what did I do? Because I'm not in my optimal position to start, I need to add in another leg. And I think we did a video on it. If not, I'll try to do one. And I showed it. Someone asked what was one of your best trades. And it was one of the best was in sugar of March of, I think it was March of the 2006 contract. I had chunks of that from 8, 9, 10 all the way up to 18. It was definitely the best trade of the year. I'll talk about that account in a minute. So then what I said was, well, if I get into these positions and use the same criteria, but I'm trading half as big with the proviso that I'm going to add to the winner, if I'm early in my timing, right, and I have which is bad timing, my drawdown would be smaller. Why? Well, because my initial position now isn't the optimal position. I'm going to have to work into that. I'm going to lose less money up front when my anticipation or my intuition is off. Or if it's good, but I'm early. Because early means you're wrong. If I'm early and it comes back against me, doesn't matter what happens tomorrow, because I can only manage risk in the ever-evolving moment and now. I can't come back and say, I have my stops placed and I'm super close. I'm just going to adjust them because I know the thing's going to go back up. I don't give myself permission to negotiate with myself to abandon my stops. Those things are the only thing that'll preserve your capital. And if you turn your back on your stops, you actually are betraying yourself. That's my belief. You might think differently, but that's what I would say if you were working for me. I'd say, you're not doing yourself any favors by staying in losers, right? And I'm not the only one to say that, right? Go read Ace Greenberg's book, which I have somewhere. It might be in my closet. It's The Rise and Fall of, it's actually right there. It's The Rise and Fall of Bear Stearns. Decent book, rest his soul, Ace Greenberg. Alan is dead. But he basically said to his prop traders, no matter what you think about a name, and it can be as blue chip as something like AT&T, I think was the example, or maybe McDonald's, names that anybody who's not even a stock trader or an investor would know. If it's down coming into Friday's close, which, today is actually Friday, even though you're watching this Monday, it's 2 minutes to closing bell. If you have something that's got a bracket around it, it goes, it trades. Doesn't matter how blue chip it is, because big losses have to have been small losses at one point, and you just let them grow up. So you have to conjugate that with your position size. So I went to school on myself and said, I can't beat myself from trusting my instincts and getting into trades early where I had bad timing. Like, that's the way I use early. I'm early on the trade. It's mean I got bad timing, but it eventually works out. Now, you only know that after the fact. But if you keep the criteria the same, then you can go back and kind of lab test the thing. And I realized, like, if I came in with half the position size and I was early, i.e. wrong, my near-term drawdown was much smaller. And I've said to you, I say it to myself as almost a prayer, what you don't lose, you don't have to earn back. And once your drawdown goes beyond 10%, now you're putting more pressure on yourself to perform. You might be using more leverage at that point, and you literally and figuratively dig yourself into both a financial and an emotional hole. That's not where you want to be. You want to feel confident even if you're in your drawdown. Why? Well, because the best you can do is to follow your rules. You're powerless over the results. Just follow whatever your rules are. If they're discretionary rules, then focus on, maybe cup and handle. Whatever it is for you, 5 and 20 crossovers. I don't care. Doesn't matter to me. To the extent that you're successful is the only thing that I care about. I don't have any judgment as to how you do it, right? There's some people who just don't like chocolate ice cream, right? So figure out what's best for you, but you have to try that. So then a miracle happened, right? And this comes from making the attempts and feeling the feelings that go with the uncertainty of trying something new. Then I need, what's the criteria for adding the second piece? Because it's the 2 half pieces that make me into my optimal spot, my optimal position that I want to get in. But how can I steal second base without taking my foot off first? That's the question you have to answer, because you don't get reward if you don't take the risk. And I knew that inherently, right? That's kind of how I'm built. I tend, as a human being, I would say that I'm slightly impulsive because I have good instincts and I trust myself. Super messy if you were on the outside looking in. But I typically trust myself. I trust my instincts. I trust my intuition because I put so much thought into what my dreams are. And then I start chipping away at taking action because if you don't try, you're not going to get anywhere. So you have to invite the failure. It's the only way to win. So then you have to say, okay, well, I'm going to put a governor then on what is that risk? What risk am I willing to feel? That's a tongue twister. What risk am I willing to feel and take on financially and the emotional stuff that goes with those positions? So in that regard, I'm kind of fearless. I don't have any problem with losing money, but I started testing it. I tried it, found a good criteria to add to my winner. And then I found something else interesting is that if I actually cut what that optimal position size was by 3/4 and thought about having 25 basis points, that's not 25 basis points, but if your goal was to eventually get loaded up to hypothetically 1,000 shares and you don't have to use round numbers, you would think of 4 risk units of 250 shares. So what happens when you're early in that case, i.e. early meaning wrong, you lose even less. Then you have to have the criteria to how do you add additional risk units when it starts moving in your favor? Well, you have to pay higher prices. But my take emotionally is that you'd rather be buying when there's other buyers than trying to buy on dips when people might be looking for, liquidating to take some profits, day traders, this and that. One thing that you can use, I don't like necessarily using indicators, but one thing you can do is watch the behavior of the instrument that you're looking at. And I know a lot of you, because you email me and message me privately, are looking at NVIDIA, not necessarily because of any earnings or whatever, but because of the promise of AI. And I think ChatGPT adds to that fundamental chatter, that story, that rhetoric, some people would call it drama. So that's harder to gauge because it's super subjective. You can believe what you want to believe, right? And it comes down to religion. What are you but for your faith, right? Some people are like, I don't believe in God. Well, that's okay. You wouldn't make a good Christian or a devout, Jew. It doesn't matter to me what religion you are. But what I'm saying is, if you look at those names and how do they perform if they're making new highs coming into Friday? NVIDIA, whether I like it or not, is a darling, and it closed near the 52-week high Friday after a week of decent movement. So that tells you a lot, at least you got to manage risk, but it tells you a lot fundamentally of what people think. They had every opportunity to sell the thing. It's making 52-week highs, at least as of Friday, and it closed near those highs as well. That's kind of bullish, at least. Doesn't mean you can throw caution to the wind, but those are the types of indicators you can watch more than the indicator proper. It's more like what's the behavior of the instrument, right? So then you find the criteria to say, well, I'm only going to take 1/4 of my optimal position. I'll have to find a way to add 3 more risk units in that regard. The benefit in the short run is that when I'm early, i.e. wrong, I have a smaller drawdown. That's even better for me because as a trader, in my humble opinion, now Mike Bellafiore might say something different, I know Mike for 20 years. I don't want to, I'm not putting words in his mouth. I'm just saying that someone that we might have a different flavor and come to a similar solution, but in a different way, right? So I would say, again, what you don't lose, you don't have to earn back. You also then don't have to go to bed Friday night or have any type of duress because now you're in a drawdown and you emotionally need to win the money back as much as you need to win it back financially. That just puts you in a grind. And I know I've been there. It sucks. It's the worst. It's the worst part of trading is that if you get into a drawdown and it's too big, then how do you dig your way out? Because without discipline, you start taking flyers, you trade too big, I got to earn it right back because I don't like the feelings of being in the drawdown. And, that's just the way that it goes. So I would say, look, man, take your time, trade smaller, right? Most of the pros, if you read Market Wizards, right, a lot of them said take your initial size, cut it in half, and then cut it in half again. Well, that's what I just did. Then I had to find a way to add to my winners and build into that optimal position. And that gave me great solace because then I invested my gains into my protective stop. They weren't big gains because I was only on 1/4 my optimal size. But the key is that I got to manage the drawdown. So that's why so many people say, and I would advocate too, that even as a speculator, job number 1 is to play superior defense. Forget being Michael Jordan. Think about Lawrence Taylor, the famous giant linebacker, probably greatest of all time. So focus on defense. That means you might have to be super selective. right? And that sucks because if you have the sense of urgency, like I need to do executions, I don't feel that need, right? That was the original question. How many executions do you need? I don't necessarily have data that says I need to make 24 trades a week in order for me to hit my goals. I need to be super, super selective and buy into the winners that I already have. So that audience, that universe is terribly small for the thousands of securities that trade. It might be only 1 in 1,000 name that you're even looking at, right? So I would encourage you to be hyper selective, be very vigilant, don't trade too big, and give yourself a lot of outs. Because think about it. To be honest with you, now I'm looking at 1/10 of 1% to 1/4 of 1% as my initial risk unit. That means I could add 10 times to get to my optimal spot. But again, think about defense. If I'm risking 1/10 of 1% on a trade and I'm wrong 10 times in a row, which could be a combination of a whole bunch of stuff, bad luck, bad timing, bad analysis, it tends not to be bad analysis because I kind of sit and wait, but I'm not infallible, right? I'm not infallible. I can still make bad analysis, I suspect. But the point being is that if you're risking 1/10 of 1%, I could be wrong 10 times in a row and I still have 99% of my starting capital, or at least whatever that high watermark was. So therefore, I don't care about losing 1/10 of 1%. I'm very free. I'm liberated. I can put on any or all of those trades and it doesn't bother me. Now, as the first 1/10 of 1% risk unit starts to move and I start to add, I have small bits of capital gains, nothing close to what I'm working for. Some of you are like, dude, I'm done by 4 o'clock Eastern. What are you talking about 10% point, 10 basis point risk units? I don't have time to get on 10 trades in the same instrument during the day. And say, okay, well, I celebrate your style, whatever works for you. I'm just saying for me, when I was trading, I was trading 200 to 500 basis point risk units. And you get all that goes with that. You get the drawdown and you get the upside. I'm going to talk about that tomorrow. So I wouldn't look to optimize, I guess, is the answer. The number of trades that I put on is largely irrelevant. Think about it this way. Suppose you trade a sector fund and you just look at NVIDIA and the sector of semiconductors. When the season is hot and people are rolling money into that sector is going to go perhaps parabolic. But guess what? When that sector falls out of favor, it doesn't even matter how good the best name is. It doesn't matter how strong that horse, the best horse in the barn is, because the sector sucks. You see? So I would, if I was trading like that, I could easily be in a sector that's super hot, like say the softs in the commodity space were going berserk. I might find myself having 25 fills, but that's just incidental because the sector is getting all that attention and I'm getting triggered. But I'm not sitting there saying like, I'm going to sit and do this. So the number of trades really don't matter, because then you also have to consider that I'm probably trading smaller, even though I have more money than probably the majority of you out there. I'm still trading as a percentage much more conservatively than you might be, because that meets my emotional needs. It meets my emotional needs that if I get knocked out because I'm early, meaning wrong, I'm not going to lose a lot of money and dig myself into a drawdown. So that means when I do catch the move, I can add into the winner and then the thing goes. You see? So think of that with your own trading and how that might make sense for managing the drawdown. Because again, if you don't have plans on how you're going to manage the drawdown, it's going to manage you. And that sucks. That's not where you want to be. And you can avoid that if you know ahead of time how that market activity could unfold. And you also have a clear understanding that there's 2 payoffs to every trade. There's the financial payoff. There's the emotional one. You gotta monitor both. You have to manage both. So anyway, I've been blathering on here almost for 20 minutes. Sorry, but when you ask me like what I do, I'm typically very guarded. I don't really talk about what I do, but to the extent that it can help you compare it to your own behavior, then you have something to go by. There's a yardstick, right? So please consider liking and subscribing. If I've said anything on the show that resonates with you, good or bad, please leave a comment. I don't have all the answers. I only have my own 35 years of very subjective experience, and I'm happy to share that with you to the extent that it would be valuable. Thanks very much for being here, folks. I will see you tomorrow. Okay, everybody, thanks for being here. Please take a minute, like and subscribe to the show. You could also leave a comment. I don't have all the answers, so it's good to get some feedback. Also, if you would like to support the show, check out the links below. You can get the free audiobook of The Inner Voice of Trading, and also information about the course that I teach with Victor Sperandio. Thanks for being here, folks. I'll see you tomorrow.